This is John AG, and I'm about to show you the crime scene evidence that proves the silver crash wasn't a crash at all. It was a heist. I have the warehouse logs right here in my hand. While CNBC was telling you that silver crashed because nobody wanted it anymore, while Kitco was running headlines about weak demand, I was doing what I always do. I was reading the vault receipts. And what I found will prove to you, beyond any reasonable doubt, that this market was robbed in broad daylight. Here's the headline that broke everything wide open. Large chunks of silver leave China and COMEX warehouses after latest price crash. That's from SilverSeek. But here's the number that should make your blood run cold. 195 tons of physical silver vanished from Shanghai vaults in just 15 days. Asterisk, not months. Not years. 15 days. From January 20th to February 4th, 2026. Let me say that again for the people in the back. While the price of silver was supposedly crashing because nobody wanted it, someone was loading 195 tons. That's 195,341 kilograms. That's 31.5% of Shanghai's entire registered silver inventory onto trucks and ships and making it disappear. Does that sound like weak demand to you? Does that sound like panic selling? Or does that sound like someone knew exactly what they were doing while you were staring at red candles on your screen? I'll tell you what it sounds like to me. It sounds like a robbery. It sounds like the greatest precious metals heist of the 21st century. And by the end of this video, I'm going to prove to you mathematically, not with opinions, not with theories, but with math, that this crash was rigged from the start. Here's what I'm going to cover in the next 20 minutes, and I need you to stay with me because every single piece of evidence builds on the last. First, I'm going to show you the vault drain. The exact numbers from COMEX and Shanghai showing precisely when the metal left and where it went. Second, I'm going to reveal the weapon they used, a mathematical event so rare it should happen once every 1.07 billion years. That's not a typo, a 7 sigma event, 1 in 390 billion chance. And I'm going to prove it wasn't natural. Third, I'm going to show you the mechanism. A single leveraged ETF with $10.6 billion in silver exposure that was mechanically forced to dump $4 billion worth of silver futures at the exact bottom of the crash. At 1:25 p.m. Eastern Time on January 30th. To the minute. Fourth, I'm going to show you why retail couldn't fight back. The New York Fed just released the data. $1.28 trillion in credit card debt. Delinquency is at the highest level since 2017. The average American was broke, over-leveraged, and perfectly positioned to be shaken out. And finally, I'm going to connect all the dots and show you who was buying while you were selling. Spoiler alert, it's the same bank that paid $920 million in fines for manipulating precious metals markets. And they were standing for physical delivery at $78.29, the exact bottom tick of the crash. But before we dive into the evidence, I need to do a roll call. I need to know who survived this, who held on while the algorithms were hunting your stop losses. Pause this video right now. Go down to the comments section. Tell me 2 things. Where are you watching from? Your city, your country. And second, did you hold or did you sell during the crash last week? I want to see who the banks couldn't shake out. I want to see who the strong hands are in this community. Comment now. I'll wait. Because here's the thing. They wanted you to sell. They needed you to sell. The entire operation was designed to trigger your stop losses, trigger your margin calls, trigger your fear. And while you were selling, they were buying. While the price was going down, the metal was going out of the public vaults and into private hands. That is not a bear market. That is not capitulation. That is a transfer of wealth from weak hands to strong hands. And I have the receipts. Let's start with the crime scene. The first thing any good detective does at a crime scene is establish the facts. What happened, when it happened, and what evidence was left behind. So let's look at the vaults. COMEX, the largest precious metals exchange in the United States, has been bleeding silver since January 1st, 2026. 50 million ounces have left the registered vaults. That's not a withdrawal. That's an exodus. That's 1,555 tons of physical metal that was sitting in warehouses in New York and is now somewhere else. But the real story isn't COMEX. The real story is Shanghai. On January 20th, 2026, the Shanghai Futures Exchange held 619,854 kilograms of registered silver in its vaults. By February 4th, Just 15 days later, that number had dropped to 424,513 kilograms. Do the math with me. 619,854 minus 424,513 equals 195,341 kilograms. That's 195 tons. That's a 31.5% reduction in total registered inventory in 2 weeks. Now, I want you to think about the logistics of that for a second. We're not talking about paper contracts being shuffled around on a computer screen. We're talking about physical metal. 6 million ounces of actual, tangible silver bars. Each bar weighs about 1,000 ounces. That's 6,000 bars. Those bars had to be pulled from warehouse shelves, loaded onto pallets, secured in trucks, driven to ports or airports, and shipped out of China. That doesn't happen by accident. That doesn't happen because of panic selling. That is planned. That is coordinated. That is a whale-sized buyer executing the largest physical silver withdrawal in recent Shanghai history, while the price was supposedly in free fall. And here's the part that should make you angry. While this was happening, while 195 tons was leaving Shanghai, while 50 million ounces was leaving COMEX, what was the financial media telling you? Silver crashes on weak demand. Speculative bubble bursts. Retail investors flee precious metals. Weak demand. Weak demand. Someone just bought 195 tons of silver in 15 days, and you're telling me demand is weak? Let me put this in perspective. The United States Mint produces about 15 million silver eagles per year. That's roughly 467 tons annually. In just 15 days, Shanghai vaults lost almost half of the annual U.S. Mint production. And we're supposed to believe nobody wanted silver? No. What happened was this. The price went down, but the metal went out. And that, ladies and gentlemen, is the textbook definition of a heist. But it gets better, because we can actually see who was taking delivery on COMEX. And when you see the name, you're going to understand exactly how deep this goes. January 7th, 2026, 1,624 silver contracts stood for delivery on the COMEX. Each contract represents 5,000 ounces. That's 8.1 million ounces of physical silver that changed hands. Now, normally, deliveries are spread across multiple banks, multiple dealers, multiple market participants. Not this time. JPMorgan Securities delivered 99% of that total. Let me say that again. One bank delivered virtually all the silver. 99%. Not 60%. Not 75%. 99%. That's not normal market activity. That's not how commodity exchanges usually function. That's one entity controlling the entire supply chain on delivery day. And here's what makes this even more suspicious. Despite 1,624 contracts being delivered, open interest for January silver futures increased by 1,431 contracts that same day. February silver contracts increased by 1,564 contracts. Translation: demand wasn't being satisfied. It was accelerating. People weren't getting out of silver. They were getting iron. But the price was about to crash anyway. Why? Because the algorithm was already loaded. The weapon was already in place. And all they needed was a trigger. Which brings us to January 30th, the day of the massacre. Let me teach you something about statistics that they don't want you to understand. Because if you understand this, you'll never look at market crashes the same way again. In statistics, we measure how unusual an event is using something called standard deviations, or sigma. In a normal distribution, a bell curve, here's how the math works. A 1 sigma event happens about 32% of the time, roughly twice a week in the markets. Totally normal. A 3 sigma event happens about 0.27% of the time, maybe once a year. Unusual, but it happens. A 5 sigma event, 1 in 1.7 million, should happen once every 4,776 years, once in all of recorded human history. Now let me tell you about a 7 sigma event. A 7 sigma event has a probability of 1 in 390, 682, 215, 445. That's 1 in 390.7 billion. According to the standard Gaussian distribution model, a 7 sigma event should occur once every 1.07 billion years. To put that in perspective, you have a better chance of being struck by lightning twice in your lifetime than witnessing a single 7 sigma event in a naturally functioning market. You have a better chance of winning the Powerball lottery over 1,300 consecutive times than seeing a 7 sigma move happen organically. And yet, on January 30th, 2026, silver experienced what Daniel Pavlonis, senior commodity broker at RJO Futures, described as a 6 sigma to 7 sigma level event. Kitco News ran the headline, "Silver's Parabolic Rally, a 7 sigma event, where YOLO Traders turned $20,000 into $5 million. Pavlonis himself stated, "From the perspective of professional traders, such extreme volatility was completely beyond normal expectations and difficult to believe. Difficult to believe. Difficult to believe." Let me be very clear about what I'm saying here. A 7 sigma event doesn't just happen. It doesn't occur naturally. The math says it should happen once every billion years. We don't get to see one in our lifetime. We don't get to see one in 1,000 lifetimes. So when it does happen, when multiple 6 to 7 sigma moves occur in the same week, there are only 2 possible explanations. Option 1 ***, we just witnessed the most statistically improbable event in the history of financial markets. Something rarer than being struck by lightning twice. Something that defies 1 billion years of probability. Option 2 ***, the market was rigged. I know which one I believe, and I want to know what you believe. Type in the comments right now. Do you think a 1 in 390 billion event happens by accident? Or was this a coordinated attack to clear the vaults cheaply? Type accident or rigged. Let's see what this community thinks. Because here's the thing, I'm not asking you to trust me. I'm asking you to trust the math. And the math says this was impossible. But let me show you exactly how they did it. Because it's not enough to say the market was rigged. I need to show you the weapon. I need to show you the mechanism. I need to show you the exact moment the algorithm pulled the trigger. The weapon was called AGQ. The ProShares Ultra Silver ETF, ticker symbol AGQ, is a 2x leveraged ETF that tracks silver prices. If silver goes up 1%, AGQ goes up 2%. If silver goes down 1%, AGQ goes down 2%. It's designed for traders who want amplified exposure to silver's daily moves. Going into January 30th, AGQ had $5.3 billion in assets under management. Because it's 2x leveraged, that meant it controlled $10.6 billion worth of silver futures exposure. Ole Hansen, head of commodity strategy at Saxo Bank, documented this as the largest leveraged silver position in history. Now here's where it gets technical, but stay with me because this is the smoking gun. AGQ has to rebalance every single day to maintain its 2x leverage ratio. It calculates its net asset value at exactly 1:25 p.m. Eastern Time. On a normal day, this rebalancing is minor, a few adjustments here and there. But January 30th wasn't a normal day. Silver had hit an all-time high of $121.67 the night before on January 29th. Then, in the Asian session on January 30th, the Shanghai Futures Exchange silver contract closed down 17%. The crash had already started before U.S. markets even opened. When U.S. markets opened, the cascade began. Margin calls started triggering. The LBMA silver benchmark had settled at $103.19 at 7 a.m. Eastern. But by the time COMEX opened, silver was already in free fall. Then came 1:25 p.m. Eastern Time, AGQ's daily rebalancing window. Here's the formula for what happened. Force selling equals X, 1, delta S, where X is the leverage factor, 2X, and delta S is the percentage change in silver price. With silver down approximately 35% from the high, AGQ was mechanically forced to sell an amount equal to roughly 60% of its net asset value. The dollar amount? Ole Hansen estimated approximately $4 billion in silver futures selling during that rebalancing window alone. Quantitative trader Andy Constan identified 1:25 p.m. Eastern Time as having caused a local low in silver prices. That wasn't human judgment. That wasn't panic. That was an algorithm executing a programmed sell order at the worst possible moment. And here's the death spiral it created. Silver drops, AGQ's net asset value drops. AGQ must sell futures to rebalance. More silver selling silver drops. Further, more forced rebalancing margin calls trigger on other leverage positions additional selling repeat until the system exhausts itself. This is what's called negative gamma. Leveraged ETFs have to trade in the direction of the move. They have no choice. It's mechanical. It's programmed. And on January 30th, it created a self-reinforcing liquidation cascade that drove silver from $121 to $78 in a single session. AGQ fell 60 to 66% in one day. That's not volatility. That's annihilation. And here's the final piece of evidence that proves this was coordinated. During a normal panic crash, implied volatility explodes. Fear drives option prices through the roof. But on January 30th, silver's implied volatility fell by 10.6% during a 20% plus crash. That's impossible in organic selling. Falling implied volatility during a crash signals coordinated position unwinding. It signals that this wasn't fear. This was a planned operation. 3 separate mechanical selling pressures converged simultaneously. 1. Margin call liquidations from leveraged long positions. 2. AGQ's $4 billion rebalancing at 1:25 p.m. 3. The CME announced a third margin increase in 3 days, a 36% hike, compounding the liquidation pressure. They raised margins from 9% to 11% on January 28th, then to 15% effective February 2nd. 3 increases in 17 days during the most volatile period in silver's history. That's not risk management. That's a margin trap designed to flush out retail positions. And it worked. By February 3rd, silver briefly touched $71.38, a total decline of 41% from the peak. AGQ's Bollinger Bands, a measure of volatility, had expanded to 335 points, more than 3 times their width from a month prior. But here's what you need to understand. While all of this mechanical selling was happening, while algorithms were dumping billions in futures contracts, while retail traders were getting margin calls they couldn't meet, someone was buying. And that brings us to the victims. The broke consumer who never stood a chance. On February 10th, 2026, the Federal Reserve Bank of New York released their quarterly report on household debt and credit for Q4 2025. The numbers are devastating. Credit card balances surged to a record $1.28 trillion. That's with AT. That's a $44 billion increase in just Q4 alone, a 5.5% year-over-year increase. Let me put that in context. 175 million Americans hold credit cards. Nearly 60% of them carry a balance from month to month. And the average interest rate on those balances? Around 20%. 20% interest on $1.28 trillion in debt. But it gets worse. Aggregate delinquency rates rose to 4.8% of all outstanding U.S. household debt, the highest level since 2017. Bloomberg specifically reported this was driven by higher defaults among low-income and young borrowers, adding to evidence of what they called an increasingly bifurcated economy. The New York Fed researchers used a specific term, a K-shaped economy. That's where upper-income consumers continue spending and accumulating wealth while lower-income Americans drown in debt. Total household liabilities hit a record $18.8 trillion in Q4. Mortgage balances, $13.17 trillion. Auto loans, $1.67 trillion. Student loans, $1.66 trillion with a delinquency rate of 9.6% for loans 90-plus days past due. Now let me connect the dots for you, because this is where the heist becomes obvious. The average retail silver investor in January 2026 was already drowning in debt at 20% interest rates on credit cards. They were riding the silver rally from $60 to $120, probably on margin, probably leveraged, probably using money they borrowed because they believed silver was going to the moon. And they were right. Silver was going to the moon. But they never understood that the banks weren't going to let them come along for the ride. When silver crashed 35% in one day on January 30th, these over-leveraged retail investors faced margin calls they could not meet. The CME had just raised margin requirements from 9% to 11% to 15% in the span of 2 weeks. That meant they had to post more capital at the exact moment the market was collapsing. But here's the problem. They didn't have more capital. They were already maxed out on credit cards at 20% interest. They were already delinquent on student loans. They were already struggling with auto payments and mortgages. The K-shaped economy meant that wealthy institutional players, the banks, had unlimited liquidity to buy the dip. They could stand for physical delivery at $78.29. They could accumulate 195 tons in Shanghai while the price was crashing. But the retail investor, the average American, they had no choice but to liquidate at the worst possible prices or get liquidated by their broker. This wasn't an accident. This was targeting. The banks knew the consumer was broke. They had the same New York Fed data we're looking at right now. They knew delinquencies were at 2017 highs. They knew credit card debt was at all-time records. So they engineered a crash that would force maximum liquidation from the people who couldn't afford to hold on. Chris Marcus of Arcadia Economics stated it perfectly. The volatility and the recent sell-off is a result of continued illegal manipulation in the paper markets by the bullion banks in a futile effort to keep the price contained. This is blatantly obvious to anyone with even basic charting skills. But let me show you the ultimate proof. Let me show you who was accumulating while retail was capitulating. Remember JPMorgan? The bank that delivered 99% of the silver on January 7th? The bank that paid a record $920 million fine in 2020 for manipulating precious metals futures markets through spoofing, placing hundreds of thousands of fake orders from 2008 to 2016. On January 30th, 2026, JPMorgan Securities stood for delivery of 633 contracts. That's 3,165,000 ounces of physical silver. And what price did they lock in for that delivery? $78.29, the exact bottom of the crash, to the penny. The same bank with a criminal history of precious metals manipulation was taking physical delivery at the precise moment of maximum market dislocation while retail investors were being forced liquidated out of their positions. And they weren't done, because there was another arbitrage opportunity happening in real time that proves this was coordinated. The SLV ETF, the largest silver ETF in the world, was trading at a 20% discount to its net asset value on January 30th. In a normal crash, shares outstanding should decrease as investors flee. But iShares data shows SLV shares outstanding increased by 51 million shares from Thursday to Friday. Why? Because authorized participants, which includes banks like JPMorgan, were buying discounted SLV shares on the open market, redeeming them for physical silver at full net asset value, and pocketing the 20% difference. The forensic analysis said it best. The fox didn't just guard the henhouse. It engineered the panic, bought the eggs at a discount, and sold them back at full price, all in the same day. But there was one group of traders who actually won during this chaos, and their story reveals something important about how the game is really played. Daniel Pavlonis documented what he called YOLO Traders, speculators who came from the crypto space and bought deep out-of-the-money call options when silver was trading at $39. They bought $100 strike calls when silver was at $39. These options were essentially lottery tickets. Extremely cheap, extremely risky. But when silver surged from $39 to above $120, those lottery tickets went massively into the money. Pavlonis confirmed. Some individuals turned an initial investment of $20,000 in such options into gains of $5 million. These YOLO traders did the opposite of what traditional smart money does. While the professionals were selling into strength and managing risk, the YOLO traders kept buying more deep out-of-the-money calls at $130, at $150, betting on further upside. And in this specific event, they outperformed the veterans. Now, I'm not recommending you become a YOLO trader, but I am pointing out something important. The people who won were the ones who either A, had deep enough pockets to take physical delivery at the bottom, or B, were willing to make asymmetric bets that everyone else thought were crazy. The middle-class retail investor who was over-leveraged on margin, they got wiped out. And that was the point. Let me summarize the evidence. Evidence item 1, statistical impossibility. A 7 sigma event has a probability of 1 in 390.7 billion. It should happen once every 1.07 billion years. Multiple 6 to 7 sigma moves occurred within a single week. The probability of this happening naturally is mathematically zero in the lifespan of our universe. Evidence item 2. The AGQ time bomb, a single leveraged ETF with $10.6 billion in futures exposure, was mechanically forced to dump $4 billion in silver futures at exactly 1:25 p.m. Eastern Time on January 30th, creating the precise low of the crash. This was programmatic. This was predictable. This was not discretionary selling. Evidence item 3. The margin trap. The CME raised margins 3 times in 17 days. 9% to 11% to 15%. They escalated capital requirements during the most volatile period in silver's history, ensuring maximum retail liquidation. Evidence item 4. JPMorgan's footprint. The bank, with a $920 million fine for precious metals manipulation, delivered 99% of all COMEX silver on January 7th. Then they stood for physical delivery of 3.165 million ounces at $78.29 on January 30th, the exact bottom tick of the crash. They were accumulating while retail was being exterminated. Evidence item 5. The implied volatility anomaly. Silver's implied volatility fell 10.6% during a 20% plus crash. In organic panic selling, implied volatility explodes. Falling forward during a crash signals coordinated position unwinding. This was a planned operation, not fear. Evidence item 6. The consumer trap. $1.28 trillion in credit card debt at 20% interest. Delinquencies at the highest level since 2017. The average retail investor was financially incapable of meeting margin calls, making them the perfect target for a forced liquidation event. Evidence item 7. The vault drain. While the price was crashing, 195 tons of silver disappeared from Shanghai vaults in 15 days. 50 million ounces left COMEX. The price went down, but the metal went out. That is the definition of a heist. So here's my verdict as the lead forensic analyst. This was not a natural market event. This was a coordinated operation designed to transfer physical silver from weak hands to strong hands at artificially suppressed prices. The weapon, a 7 sigma algorithmic event targeting leveraged positions. The mechanism, forced selling from AGQ rebalancing and cascading margin calls. The trap, a broke consumer base unable to meet capital requirements. The beneficiaries, banks with criminal histories of precious metals manipulation taking delivery at the bottom. The evidence, vault drains happening simultaneously with price crashes. The heist is complete. The metal has moved from public hands to private hands, from retail investors to institutional whales, from weak hands to strong hands. And now we come to the only question that matters. Where does the silver price go from here in 2026? The vaults are drained. The weak hands are out. The strong hands are loaded. Gold is holding above $5,000, proving that the precious metals bull market is intact. Silver has found a floor and bounced from $71 to $76. So I want to know, will we see $100 silver in 2026? Type yes or no in the comments. Leave your price prediction. Tell me where you think this goes. Because here's what I believe. The heist may be over, but the shortage is just beginning. They can manipulate the paper price. They can trigger algorithmic crashes. They can raise margins and force liquidations. But they can't create physical silver. They can only take it from people who are forced to sell. And those people just sold. The weak hands are gone. The vaults are lighter. And the next wave of demand is coming. When it does, there won't be 195 tons sitting in Shanghai to satisfy it. There won't be 50 million ounces waiting in COMEX warehouses. That metal is already spoken for. It's already in strong hands who aren't selling. So yes, they won the battle. They executed the heist. They crashed the price and drained the vaults. But the war isn't over. Because supply and demand always win eventually. And right now, supply just got a lot tighter while demand from industrial users, solar panel manufacturers, EV producers, and strategic buyers hasn't stopped. The mainstream narrative will tell you the silver story is over. That the bubble popped, that it's time to move on. Don't believe them. They're the same people who told you silver was crashing from weak demand, while 195 tons was being loaded onto trucks. The data doesn't lie. The market does. This is John AG. We don't trade the price. We trade the corruption. And now you know. The forensic autopsy is complete. The crime scene has been documented. The smoking guns have been presented. What you do with this information is up to you.